I'm Linda Eedes, and welcome to our Mind of the Manager webinar. Today's theme is making sense of the global investment landscape. So we're going to be weighing in on all the disruption that we've seen over the year to date, from Trump's tariffs to China, geopolitics to the GNU. We're going to be talking about what's going on with the larger economies, but also most specifically talking about where we invest as a result. So we're also going to be getting you involved, by the way, so look out for a few polls, technicals permitting. We'd like you to weigh in on your views along the way as well. So to join me to unpack these insights are two of our portfolio managers. On the far end, Nick Balkin, our Chief Investment Officer and also Portfolio Manager for several of our funds. And then Rashaad Tayob, who is our macro strategist, but also manages some of our multi-asset portfolios as well as our fixed income strategies as well. So to give us some context to start, we're going to look at a few slides which just tell us a little bit about the history of globalization that we've seen over the last few decades. So if we look at this slide here, we're looking at the history of global trade of goods, which goes back to 1950s. And you can see how the global trade of goods has risen dramatically since the 1970s, well into the 80s and 90s. And the value of global goods traded today is actually up fivefold since the 1990s. So today, the global economy is worth about $100 trillion. A quarter of that is actually made up of global goods traded around the world. So the world truly has become globalized in nature over the last 50 years. And to give you an example, let's just take this iPad, for instance. So the raw materials in this iPad come from around 10 different countries around the world, some of which are obviously here in Africa. The component manufacturing, things like the chips, the screens, the batteries, and other hardware are sourced from 15 different countries. The design and software was, of course, done in the US, and the final assembly was either done in China, Vietnam, or India. And then, of course, it's shipped to over 100 different countries around the world, including here at the tip of Africa in South Africa. So all in all, more than 30 different countries have actually been involved in the global life cycle of this iPad. So that just gives you an idea of how globalization has touched each and every one of our lives and has given us access to a number of goods which we would never otherwise have for the price we had them. And if we look at the benefits to the world of that globalization, of course, we've seen GDP growth around the world increase. Many countries have benefited from that. But another great benefit is over here, you can see the orange line actually represents world inflation. So you can see how world inflation has trended down pretty much in proportion in direct, obviously opposite direction from the rise of global trade. So that has actually been a benefit to countries around the world. And one of the things that it's allowed is countries to really prosper as a result of their ability to produce goods at a cheaper price and supply them to many of the developed economies. So you can see in the background there that gray shaded area represents the world GDP as that has grown. And you can see the United States is the pink shaded section. But what has also happened is that the percentage of global GDP that the US represents has also fallen as those countries have obviously prospered off the back of that globalization. So you can see that the US's share of global GDP has actually fallen from 40% in 1960 to something closer to 26% last year. Now, more recently, we've seen a drive to actually reverse the sort of globalization trend that we've seen. And here we see the average effective tariff rate for the US on US imports. And this recent spike up is, of course, the recent announcements that Trump made. And you can see that tariffs have pretty much trended downwards along that entire time, which has actually enabled that global trade to grow. And more latterly, we've seen this dramatic sort of reversal of that. So what we're going to be addressing today is really what that actually means for the world. And if we think about, the fact that the world has opened up, we really cannot deny the fact that the world has become incredibly globalized, and that has really been to the benefit of many countries around the world. So this real sort of grinding of the gears that tariffs have potentially proposed for the global economy is something that we're going to unpack today, and also in terms of what that means for the market. So I'm going to hand over now to Rashaad who's going to give us a little bit more detail on the implications of these tariffs for the global economy.
Yeah, thanks, Linda. So you've talked about the benefits of globalization and trade for the world in terms of its ability to grow, in terms of trade's ability to have a disinflationary impact and make sure the goods that we have are more reasonably priced. So if we are going to reverse this trend through tariffs, less global trade, I think the world has its work cut out for it, and none more so than the United States, which is basically driving this deglobalization and trade agenda. This graph shows the average monthly manufacturing wages of a range of countries around the world. And what you can see is that the US, at close to $6,000 a month in manufacturing wages, has the highest manufacturing wages of the world, which is not surprising since it is actually the richest country in the world. China, on the other hand, at around $1,000 a month, you're looking at basically less than 20, or you're looking at a US wage, which is 5 times the wage of China. So when you talk about looking to move manufacturing back into the US, it comes with a massive cost implication. But I think that's not the only issue. We see, more importantly, China has spent now several decades effectively having a policy of making itself the manufacturing powerhouse of the world. It's not only about lower costs, it's about the infrastructure. It's about the fact that they produce double the electricity of the US. They've implemented 5 nuclear power plants last year, just in 2024. The US has only done 1 in the last 10 years. It's about the logistics, the technology, the ports, the shipping. Everything that goes alongside having a manufacturing base has been built and driven by China over the last few decades, while in the US, on the other hand, they've allowed their manufacturing base to effectively decline. It's literally called the Rust Belt. So if the US is serious about its intent, it's going to be a very difficult task, and it's going to come with higher costs. And I think those higher costs are going to be reflected in a higher level of inflation. You've had a nice disinflationary impact over the last few decades, where global trade and the ability to move your manufacturing and move your services to lower cost countries has kept a lid on inflation. If you are going to not have that benefit of scale of having an 8 billion consumer market which everyone is accessing, that is going to come with less economies of scale and more costs. And you are seeing that with the recent inflation surveys coming out of the US have reached very high levels, because people realize as these tariffs are being implemented, it is going to come with more costly consumer goods. And recently, we saw the fact that with people are making emergency purchases. So sales on Amazon have gone up. If you want to buy a MacBook Pro in the US, you used to be able to order it for next day delivery. Now you're only going to get it next month. So consumers are concerned that they're not going to get the products they had at the price that they used to. I think if we look at why the US is taking this strategy, it's a strategic decision to have some of the more important aspects of the economy made in-house. If you consider China to be a geopolitical rival, you don't necessarily want to be dependent on them for your pharmaceuticals, for your technology, for your semiconductors. So I think from a strategic decision, one could argue that what the US is doing is maybe the right thing for their strategy going forward. However, from an implementation perspective, I think their haphazard strategy has been quite destructive to the global as well as the domestic economy. What we have here is graphs of economic uncertainty, policy uncertainty, trade uncertainty, fiscal uncertainty. These are all at levels that we last saw during the COVID crisis. So the US, through its very aggressive tariff strategy, has made has put businesses in a position that they don't know where the tariff policies are going to be in the next month. They've increased tariffs, they've doubled them, they've then reduced them. So businesses need certainty to function, to plan their capex, and without that, I think you're going to see a pullback on investment. People can't make decisions, and I think that the probability of a recession in the US has moved up dramatically. And if these tariffs stay in place, I think it's moving towards a base case that we see a US recession in 2025. And that's affecting what fund managers are thinking. This is a very recent survey from Bank of America, where Wall Street is becoming very concerned about the prospects, not only for a recession, but even a potential hard landing if some of the more aggressive tariff measures are going to be taking place. And when you see a pullback on investment, I think that can, in a financialized system such as the US, this will have a direct impact on the economy. And a lot of the wealth is not only about the trade that you talked about, the 25 trillion of global trade, the 8 trillion of services. That's an economic impact, but it also has a massive financial impact. The performance of the stock market over the last 2 years has been driven by the Magnificent Seven. They've been the key driver of returns of the S&P 500. And when you look at global stock market returns, the S&P 500 has been the biggest driver of the MSCI World returns. So the world stock market is very dependent on these 7 stocks. And when you look at the share of revenues that you see in this graph for these stocks, besides Amazon, you have 50% to 64% of their revenues are dependent on what's coming from, are dependent on revenues from outside of the US. So these big stocks, which have been a big driver of wealth in the US, are dependent on global trade and open and free trade. And if you do cause a pullback in these stocks and a drawdown and potentially a bear market in the S&P, that will have a direct effect on the wealth of the US consumer. And the financialization of the US means that increases your probability of a slowdown in the consumer and therefore a recession. Now, the trade war has started off in a very haphazard fashion. So Trump started, he started off by attacking his neighbors, attacking Canada. But I think what we've seen in the last 2 weeks, if we boil down to the core issue, and that's essentially the fight between the US and China for global hegemony. They're the 2 biggest economies in the world and the 2 biggest military powers, and effectively they are vying for global dominance. So the question is, who has the advantage? And I think what we've seen recently by upping the ante on tariffs, but then retracting it on certain consumer goods, that the US is highly dependent on imports from China. So the tariffs have been, policy started off quite aggressive, but what we've seen is some backpedaling from Trump, and he's basically trying to get Xi to call him in order to make a deal. He's also exempted critical elements like your laptops, like your smartphones, because what he realizes is that he doesn't want to subject the US consumer to pain by putting that price of that iPad from $1,000 to maybe $2,000 if those tariffs actually had to take hold. He doesn't want there to be a shortage of consumer products like laptops. So there has been a bit of backpedaling, which is a reflection of how dependent the US is on Chinese exports. For China, on the other hand, this chart shows the percentage of Chinese exports as a percent of their GDP to the US. And what you can see is that China has managed to reduce its dependence on the US consumer from around the 7% level to just under the 3% level. Now, make no mistake, the US market is the biggest consumer market in the world. If China is effectively cut off with 100% tariffs on the US consumer, they will take some pain. However, that pain may not be existential at this point, and China has made a massive effort in order to globalize its consumer base. There's a lot more being exported around the world. It's been developing its relationships with other developing markets through the Belt and Road Initiative. And most importantly, it's trying to internalize its economy and increase the proportion of domestic consumption in the economy, so it's not necessarily reliant totally on exports. So China will take pain in a deglobalized world, but they are prepared for it, and they have been through a lot of pain already if you look at their economy over the last few years. The US, on the other hand, I think is going into this trade war with a very weak hand. If you look at this chart, which shows the level of government spending and revenues, revenues is the blue line, and that tax income has basically capped out at around the 5 trillion level. However, that gap between spending and revenue has really opened up, and effectively you've got a $2 trillion gap even in an environment where the economy has actually been growing. So if the US needs to stimulate the economy, if the trade war causes a downturn, what you tend to find is that you try to stimulate the economy, but you're already running a 2 trillion deficit. There's a limit to how much they can stimulate, given that they're already starting at a very weak point with the fiscal, with that massive fiscal deficit. And I think this weakness is exemplified by the most recent action that we've seen in the bond market, where the US Treasury wasn't necessarily the flight to safety asset. So when Trump implemented these tariffs, you saw a drawdown in the S&P of around 20%. You saw rising credit spreads. You saw the VIX, the volatility index, move above 50%. Now, these are classic signs of a risk-off event in the US. And what you've previously seen in those type of environments was a flight to safety and everyone rushing to buy Treasury bonds and those yields falling. But this time, after a very brief rally, you saw Treasury yields rise significantly from around 3.9% to 4.5%, and you saw the dollar actually depreciate. And this is really out of the norm for a risk-off event. It's something we don't necessarily see. And I think it's a sign that the dollar is losing its role as the reserve currency asset. And the US Treasury, it's lost its role as the flight to safety asset and maybe losing its role as the global reserve asset. Now, I think it may be too early to call an end to the dollar as the reserve asset, but I think this was a massive signpost that things are not necessarily going to operate the way they have been historically.
Okay, thanks, Rashaad. I want to unpack that sell-off that we saw in longer-dated US bonds a little bit further. Nick, perhaps you can come in here. There's been some speculation that it was really sort of the foreign holders of US Treasuries that sold their bonds in retaliation for the tariff. So the likes of, for instance, China. There's talk about bond vigilantes, this idea that bond investors either sell bonds or stop buying bonds, have a buyer's strike, to actually send a very strong message to the US government to be more fiscally prudent. What are your views on whether there's anything behind that, the fact that it was actually the foreign holders of US Treasuries which were sending a very strong message to the US government?
Yeah, I think everyone loves a good conspiracy theory. I also quite enjoy it. I think this is a bit of a conspiracy theory. The truth is that China's been selling down US Treasuries for a long time. So they were over $1 trillion they owned $1 trillion or more in US Treasuries a few years ago. They've now lightened that to 700 billion odd. So it's been happening as we speak. Some of the reasons we like gold is that they are diversifying from the US Treasuries over time to other instruments. So I think this trajectory has happened for a long time. I think there has been a little bit of speculation, was debunked by the FT a few days ago, that it didn't look like China was the seller. If they were the seller, it would have been a small number anyway. To be honest, I think people are panicking. The 10-year bond went from 4.4, went down into the 3s and back to 4.3. That bounce was only a few days, and it was around actually sentiment that we could see the recession that Rashaad spoke about. So that's why the Treasuries came down for a moment and then panicked maybe that it might not be the reserve currency. So there's a hell of a lot going on. I think the most important thing is we still don't think that there's value in the US Treasuries or 10-year bond at 4.3%. 4.3% is not a great return. If you think about the real yield, which is what you can get if you buy an inflation-linked bond in the US, you get just over 2%, which means that the implied inflation, if you buy a 10-year bond right now, is only 2.2%. That's not a great number. So the fact is that China haven't taken it to a crazy cheap level, the US 10-year bond. It's just the natural course of business. Everyone wants a scapegoat. Everyone wants an answer. The truth is, actually, we don't own very much 10-year bonds still, which is a signal that we don't think that it's gone to extreme levels as a result of someone selling. That doesn't mean that the Chinese won't sell the additional 700 billion if the trade war gets more extreme. There are other steps that they can take, and they will potentially do that. The overall treasury market is about a $20 trillion market in the US. So 700 billion will move the needle. 50 billion probably won't, but it depends how extreme the trade war gets.
Okay, so you mentioned that the bonds are pricing in effectively, if you compare them to inflation-linked bonds, around a sort of 2% expected inflation number. Yeah. So obviously, if inflation turns out to be higher than that, that's not going to be very good for nominal bonds. But let's talk a little bit about that, because of course there are these two sort of offsetting features of tariffs. One, that they could cause inflation, could cause prices to be higher for all the reasons that you guys have outlined, but also that they obviously could grind the gears of the economy, the global economy even, and actually cause sort of some sort of global recession. Rashaad, I wanted to talk about this because this word stagflation is being thrown around a lot, which is obviously sort of a depressed economic environment with inflation. But if we do have a significant slowdown, particularly within the US economy, will that not give room for the US Fed to actually cut quite aggressively? The inflation numbers that we recently saw come out were actually quite low. How do we square that? Will that not mean that, the Fed can then step in, cut rates aggressively, re-stimulate the economy, and looking through that all will be well?
So the recent US inflation numbers were lower than expected, but they weren't low. So core inflation is still close to 3%. Which means that, and Powell just spoke last night, and he highlighted the conundrum that you're going into a situation where inflation hasn't gone back to the 2% target, but you're faced now with a weakened economy, and those have conflicting goals. One necessitates keeping rates at maybe elevated levels, the other one necessitates maybe cutting rates. So I think it is a difficult position, but I think it is very clear that tariffs will be inflationary because the price of goods will go up. You can talk about it being transitory or not, but if you get a deglobalized world with a higher cost structure and less economies of scale, you will get higher prices. Now, if that leads to a recession, the economy falling apart and lower inflation down the line, I think that's a bit of a moot point. So I think we're very clear that tariffs are inflationary. If they cause the economy to crash, obviously, then you don't get any demand-led inflation. But I think that's when you could get the classic stagflationary environment where the Fed doesn't necessarily know what to do and may not be able to cut rates as aggressively as they have been historically, which has always been the thing to bail out the market. The market might find itself in a bit of trouble this time.
Okay, we're going to do a quick poll because I would like to know why you think Trump has actually started this tariff war. So we're going to launch a poll. What we're asking you is, what do you think Trump's real motivation is for imposing the recent tariffs? So the first option is to curb imports, create jobs, and bring manufacturing back to the US. Is that realistic? Is that what he truly believes can actually happen? And we've given you some reasons why that might be difficult. The second is the art of the deal. Is this all just a grand negotiation tactic or ploy to get the US better trade deals? In other words, he doesn't actually ever intend to follow through with this. It's really just kind of, stirring things up so that the US has a stronger hand. The third option is it's a desperate attempt to hold China's ascendancy to world superpower. Is this actually all about trying to rein in China's growth, with US trying to cling to its mantle as the world's leading economy? And then the last one is he's a mad king. He's driven more by ego than economic sense, and actually trying to make sense of everything that he's actually outlined is a fool's game. So we'd like to hear what you think about that. In the meanwhile, whilst everyone is filling out those polls, and then I'll reveal those results with you, let's just talk about fiscal spending, because one of the things that Trump has spoken about with, obviously, Elon Musk is cutting fiscal spending. So the deficit is a problem. It does mean that they're in a precarious situation. They have less levers to pull if the economy does slow. But what if fiscal spending and DOGE actually brings that back in line, and that in itself sorts out the budget deficit? Nick, perhaps you could come in there.
I mean, DOGE is a valiant effort, right? Every company, every country should be trying to spend their money as efficiently as possible. That's noble, and we really think that's one of the good things that have come out of the Trump presidency. So the problem is that Elon Musk is a brilliant man, but he has a habit of making outlandish forecasts and then bringing them down. So when DOGE first came out, he focused on a number of $2 trillion of saving. Interestingly enough, it correlates quite nicely with the $2 trillion deficit that Rashaad spoke about. as time went on, the 2 trillion became 1 trillion. And in the last few days, few weeks, he's now moved that 1 trillion down to $150 billion saving. So it's very noble. They really need to do that. The IT systems of some of those US government departments are ancient. It needs to happen. But the 150 billion should be seen in the context of the $2 trillion deficit. In that $2 trillion, 1 trillion is interest. The rest of it is actually to do with Medicare, which is basically healthcare, free healthcare to a lot of individuals, and Social Security, which is basically retirement for a lot of the workers. So that 2 trillion is not that easy to attack because they're quite structural in nature. In fact, Trump has said, don't touch those. So he's playing in a very small pool. And yeah, it is good, but it's not going to close that 2 trillion deficit, unfortunately.
Okay, let's have a look at what everybody voted. Very interesting. You should be able to see the results on your screen. 41% of the close on 400 people who actually participated in this poll voted that it's the art of the deal, that this is just Trump using it as a negotiation tactic. He doesn't actually intend to follow through necessarily, but it's to get US better trade deals. And then it was pretty evenly split between the fact that he actually does think that this might actually bring manufacturing back to the US. 24% voted for that. 24% also think he's a mad king. So quite a polarized view there between those who are actually giving Trump some credit in terms of his policy strategy and some who think he's actually completely lost the plot. And then a few, which was interesting to see, actually think that it's largely as a result of trying to curb China's ascendancy to world superpower. And that's probably a good thing because I think that might be difficult to do. So let's move on. Nick, you're going to talk about a little bit about what's happening here locally. Now, we spoke about the dollar weakening, but of course the rand actually weakened as well. So that was actually in contrast to many other currencies which actually appreciated relative to the dollar. And the rand weakening more latterly has got a lot to do with happening locally. So perhaps we can turn to you to set the scene and then also just give the viewers some idea of how we're investing with that as a backdrop as well.
Yeah, so thanks for filling out the poll. We were asked by Donald Trump to do it. So now we know who thinks he's a mad king. So if you guys don't get through the border, so just turning to my presentation. Sorry. Yeah, so one of the key things that we need to think about, obviously the world is in a tough spot at the moment. One of our hopes was that post-election, you'd see this new GNU dawn or GNU dawn coming through. There was some optimism even in this firm that there could be some structural reform by putting two parties together that probably don't agree on everything, but maybe could have put the country first. It does seem like there are pockets of excellence and performance relating to the GNU, but our optimism has slowly faded as the year has progressed. I think the budget more recently was the biggest disappointment. Everyone harps on around the VAT. Should VAT increase? Should VAT not increase? It's less of an issue around that. I think it's more of a capitulation of the SA government realizing that they need to continue to tax people to spend more on discretionary items rather than to create a growth-enabling economy. So this budget was definitely not a growth-led budget, and I think that is a big warning to the country because time is running out and we do need growth. So what this slide shows, it's also one of the Bank of America surveys. Up until pretty much a few days ago, it came out only 2 days ago, the April number is the red number. And they asked the South African investor base, do they believe that there is a growth agenda or growth reform happening in the SA government? And as you can see, the big circle showed that there was a huge amount of optimism as it came through, as the GNU was formed. But that recent budget definitely was a big wake-up call to SA investors. I think, interestingly, the global investors have actually not bought into the second rise of the GNU. They really fell for the Ramaphoria. I think they got burnt. And I think once bitten, twice shy. I think if this disappoints, you'll really struggle to attract that foreign investor back. They really didn't buy. Interestingly, if you see the flows, even though some of the SA investors did buy, the foreigners didn't actually buy it. So why is it so important? Why did I say that budget was a big disappointment? We need growth. Growth in its own self is, obviously everyone knows growth is important, but I think a lot of people associate it with, the 1%, getting growth so share prices can go up, so the top 1% can feel more wealthy. I think it's much deeper than that. Firstly, every single worker has a pension. If we get growth and their wealth starts growing, they can retire better. Not only that, Rashaad told you about the budget deficit and the problems in the US. The problem is South Africa is the same problem. We need more than 2% growth for us to just balance the books. That's not even, anything below that's not even acceptable given where our debt is at the moment. The problem is we're scoring too many own goals that we need to reverse it quite quickly. So I like to use examples. We know the Eskom example, I've spoken about it before, starting to stabilize. Transnet is another huge issue. They used to transport around 230 million tons of material, whether it was containers or resources around the country and outside the country. That number has shrunk from the 230s to closer to 150 million tons. That's a decline almost every year. There's almost no respite. So the good news is they are realizing this. They are sensing that they need to do something about it, but they realize that their coffers are empty. So there is talk around reintroducing the private sector, opening up the private sector, allowing them to bid on some of the lines. The problem for us is Transnet is quite far gone, that some of that money is just to stop the decline. It's going to take a very long time for us to start growing again. So we will see that line tick up slightly, but we need it now, and we need it quite urgently. And I don't think the impetus is there, although there is better signs from Transnet. It needs to happen much quicker than I think it is going to happen. So turning to, obviously, there's the economic side of things. One of the things that happened more recently was, this is the PE or price to earnings chart of the mid-cap index in South Africa. For us, it's a proxy of SA Incorporated share price valuations. As you can see, in 21, 22, 23, there was really a lack of hope. It was the Eskom issues. It was the election coming up that no one really knew what was going to happen. So as that happened and the election was decided and then GNU came through, there was some buying from Foord in those lows because the valuation provided the protection against the slow growth. Remember, that base case was that we had slow growth, but the valuation had already built it in around the election time. As the PE trended towards that line again, you can see in 2024, the PE got back to almost 15 times earnings, which left less for us to deal with on a valuation point of view. We started to trim some SA Incorporated shares in our equity fund and our multi-asset funds. Interestingly enough, by doing that, we created more flexibility to react during this Trump tariff tantrum, try and say that 3 times, where we saw indiscriminate selling of global share prices. US was down 20% at a point, took down every share, good, bad, ugly, everything. The job for us and what made us most interested was there's some companies that we haven't owned for a long time, like a ShopRite, that we were able to finally buy some for our portfolios because the valuation was being indiscriminately sold off. Standard Bank is another one that the PE came down to in the 6s. The dividend yield was in the 9s as you had the GNU issues, budget issues, Trump tariffs hitting at the same time. A Bidcorp's another interesting one in our minds, that it is priced in, obviously 100% of the earnings are outside South Africa, but a large part of the shareholder base is South African. So the actual price is set in South Africa. So we were able to buy Bidcorp notwithstanding the Rand weakening because it hadn't incorporated some of the weaker Rand in it. So there were many different opportunities, but I think the key part there is be driven by what you believe is on the ground happening, but also pay a lot of attention to the price that you pay. Make sure you're flexible enough to be able to react when things change. That flexibility is evident here on the next chart. So we don't tend to show these sort of charts that often, but I thought it was quite illustrative. You can see that the overall chart, if you just look at the top of the chart, is the overall weight of our resource holding within the SA equity fund at Foord. You can see we've had about 10 to 12% odds since 2023. What has changed more recently is we've reduced the diversified miners, which is the gray block, the guys that are more exposed to iron ore and property market in China, and we've increased platinum, gold, and gold ETF. So in 2023, we had around 1% of the overall portfolio in gold stocks. And as you can see, in March 2025, more than 50% of our resource weight is in gold and gold ETF, gold stocks and gold ETFs. Yes, it is below benchmark, but it is a very different change. Why do we do that? And I think we'll talk about the gold price in a few seconds. But the gold price for us is something that we've been speaking about for a very long time. It came to pass that these aren't the greatest companies, but the trajectory of the gold price was such that it would swamp some of the fundamentals of the companies in the short term. And the free cash flow yields have increased to, if the share price hadn't moved, to more than 20% from a year ago. So those are really juicy numbers that even for gold companies, notwithstanding the cost creep, were real beneficiaries of the gold price. And that is a bit of a story that sometimes people think that Foord are only long-term investors, they don't react with flexibility. And I think that's one of the charts that debunks that myth. So I spoke about the SA equity opportunities. One of the things on the multi-asset funds is interesting to us is the real yield that you can get by buying inflation-linked bonds. So inflation-linked bonds are quite new to the South African economy. That 2002 date is pretty much when inflation-linked bonds started trading in South Africa. This is the highest yield that you can achieve over and above inflation by buying the inflation-linked bond at this moment. So this is a 5-year bond, and you can achieve 4.3% over inflation for 5 years if you buy this bond at the moment. What we like at Foord is to find these asymmetric opportunities. What does asymmetric opportunity mean? Where you think that there's little downside if you get it wrong, but good upside if you get it right. So a case in point, if you overestimate inflation, or if inflation surprises on the upside, you get the full benefit in an inflation-linked bond because you'll make the 4.3%, whether it's 7% inflation or 3% inflation. It doesn't matter. You've locked that in. With a fixed coupon bond, unfortunately, you are betting that inflation is going to surprise on the downside. And if it does, you'll probably outperform the inflation-linked bond. The problem is in a world where inflation is the only way out, and there is an option that is one of the outcomes, you really do get cleaned up in some of these fixed coupon bonds. So what we've been doing more recently is we've swapped around 50% of our fixed coupon bond weight in the portfolio to a point that inflation linkers are more than 50% of our fixed income or bond allocation. So it is just about reorientating your overall portfolios to mitigate risks that might come. And I think at this moment, we're quite comfortable with that split.
Right. So let's get a bit more audience participation yet again. We've obviously spoken about the GNU. We all had very high hopes that this was going to be a part of the structural reform. More recently, that's looking a little bit more tenuous. I'd like to know what you think about the GNU and the future, and particularly whether that's going to actually be effective with or without the DA. So you should see a poll which has popped up on your screen. The question is, will the DNU be effective in driving structural reform and growth? First option is only if the DA remains part of the GNU. Secondly, regardless of whether the DA remains part of the GNU, in other words, there are other parties who are also interested in structural reform who could also be part of the solution in terms of collaboration. And then lastly, it doesn't matter. The GNU's days are numbered either way. So what that's showing is that obviously, especially with the recent budget drama, that the GNU is really there in concept alone and that collaboration is not necessarily coming through. I'd just like to get a sense sense for where you are sitting with regards to those views. Rashaad, we haven't spoken yet about the impact of US tariffs on South Africa. Now, of course, our largest exports are metals and minerals, which are largely exempted from the tariffs. Let's talk a little bit further beyond that. What are sort of some of the knock-on effects potentially, maybe us, no longer being part of AGOA? What do you think are some of the longer-term implications if this current trade regime, the US tariffs, actually persists? What is the impact on South Africa specifically?
So we do export a reasonable amount to the US, something around $10 billion, so it's not insignificant. But as you mentioned, half of it is precious metals and other type of industrial metals, which are exempt, which means that when Trump talks about these 34% tariffs, you effectively can halve that number to around 17%. But that is a dramatically higher number than the almost zero we were used to under AGOA, and roughly the 3% that would have applied if AGOA left. So the move from AGOA to not AGOA was quite marginal. But if the 17% does actually, the 34%, and you halve that to come to an average of 17 does materialize, I think what you're looking at is probably a 0.5% cut in our GDP growth for over the next year, which, if we're struggling to get to 2% now, I think that will be a significant knock. But I think on a bigger level, if you do have a broader trade war, what you're going to see is a more global slowdown. And I think when you look at that, could have a bigger impact. A lot of our exports go to the rest of the world. If the rest of the world is slowing down on a tariff basis, then that's going to have a bigger impact than just the effect on the US tariffs. And South Africa is a country which is very sensitive to risk premiums and risk assets. So if you get a global type of sell-off, the rand will be negatively impacted, our credit spreads, etc. So I think there, the knock-on impact, we're quite sensitive to global growth, and that for the knock-on impact of a more severe trade war will be quite significant than just 0.5% GDP.
Exactly that. So one of our biggest exports is minerals, which everyone knows. The second biggest export is autos. And this is, people don't understand that there's an interlink between the world, that if America tried to put up a tariff and cause some sort of issue for the European manufacturers, they will start obviously having an issue that they'll have overcapacity. So right now we produce pretty much as our second biggest export, European cars for Europe and outside America. A small portion find its way into America. But the problem is we might be the second derivative problem if they do impact and do end up being successful in bringing some auto production back. I'm not saying that they would, but talking, 2 levels ahead, we would be impacted because the Europeans would demand and the world would demand less cars from South Africa also, and we'd lose that scale benefit. So I think people don't understand that there's second and third derivatives of everything that happens in the world.
Right, let's share some of our results. I don't know if anyone from the DA is actually watching, but I think they need to know that 78% of those who voted, again over 400 people, actually voted that the GNU will only be effective if the DA remains part of the GNU. So I think the DA needs to rethink its strategy to going back to being the opposition party. Potentially this is telling them to hang in there. I'm guessing that a large part of the constituency for the DA is voting on the poll. But some cynics saying that it doesn't matter. 15% said it doesn't matter, the GNU's days are numbered either way. So Nick, we've spoken about South Africa. It's sounding pretty bleak, to be honest. And if you think about South African investors, South African equities went through a period of time between 2015 and 2020 where they barely kept up with inflation. Why do you think that this will not be the case, if you disagree with that? And how are you actually investing to actually get the returns? Because it's not only about protecting capital, it's obviously about growing capital, meaningfully above inflation. Obviously, you mentioned some names there, but if you could just give us an overview as to how you're investing with that as quite a bleak backdrop, really.
Yeah. So the truth is, it's not an environment that's that different to the last 10 years. So that's what, when I was talking, I said, our base case has just moved back to a muddle through type economy in South Africa. So we were finding opportunities already, in that slow growth environment, and we will continue to find opportunities. The good news is we aren't ginormous that we have no flexibility. We have the ability to move quite quickly. We take liquidity quite seriously within our portfolio, so we're able to move efficiently quite, when we need to. But we're small enough to buy really niche opportunities. I used examples like Premier, that we were one of the biggest buyers of Premier in the book build when Brett sold down. Premier and Wilson Bailey were two of the biggest drivers of the Foord Equity Fund last year. They are niche opportunities. Construction, we thought, would continue to grow. Bread is a real staple. So we think that if you aren't big enough and you have the ability to take a longer term view, I think you can find niche opportunities. So yeah, I think we're still very confident, given our size, that there are many opportunities in a slow growing South Africa. But it's no different to if you asked me this a year ago, 2 years ago. I think it's just our base case.
And the Foord Equity Fund has performed incredibly well. So it's really just a case of more of the same, isn't it? That muddled through environment where good businesses with, good balance sheets, solid balance sheets, good management teams are still able to actually generate good returns on capital for their shareholders, as we've seen over the last few years.
Yeah. And some of those companies in the sell-off, what gave us confidence was, as I said, if you have a sell-off, what you got to go to is, where can I have high conviction that company's earnings aren't going to change? In Shoprite's case, we didn't want to pay the higher valuations for what it was. But we thought the earnings didn't move at all. If you had the tariffs, if you had genuine cap, you still will have habitual food purchase. So there are ways and means where you can get more confidence even when there's uncertainty, and use those opportunities of dislocations to buy good companies.
And it's probably also another point to make that, sort of 50% of the South African market cap is actually global companies, which might face their own challenges with everything going on in the globe. But nonetheless, it does provide a much more diversified opportunity set than most other emerging market stock exchanges. So something that obviously
I think Rashaad,
do have
Linda, you mentioned the period, that difficult period where we were in the doldrums around 2015. And I think the big difference now is that the market valuations have really adjusted. So look at where bond yields were there, 7-8%. Now bond yields are 11-12%, and real yields were sitting at 1%. Now they're 4 to 5%. So the mid cap you showed was at a 15 PE. Now you're probably closer to 12. So the valuation the starting valuation here is really in our favor. So even if we are in a stagnation as usual environment in South Africa, at least the valuation is now in our favor and provides that protection.
Yeah.
Okay, right.
Fair point.
Nick, let's move a little bit back to the global markets. Let's talk about, sort of how this all sort of translates into valuations in global markets and our positioning there across our multi-asset funds.
Cool, thanks. Yeah, I think this is a very important chart. I was chatting to Linda and she thought it might be a bit complex, but I think it's super important. If you look at the red block, that is roughly, depending on the day, probably 2 days ago's S&P price, 5340. That's where the S&P 500's price was. What this chart shows you is what is the growth of the 2024 earnings base on the top, and what is the price to earnings of the S&P going down the column. So the row is the earnings and the column is the price to earnings. What this is saying is the S&P earnings are still expected to grow 10%. At that moment, the S&P is pricing in at 20 times PE. So that's a very important thing. Everyone talks about this catastrophe, the market sold off 20%, a real panic. It's actually retraced to only 13% down from its peak. It's still very highly rated on a 20 times forward PE. So let's do a thought experiment. Let's say because of the tariffs, earnings are actually flat instead of up 10%. Let's do another thought experiment. Let's not go extreme. Let's say that the PE moves down from a 20 times to an 18 times PE in America, which is the 10-year average, and still higher than the 35-year average. You'll still see an additional 17% down on the S&P. So just those two things. We spoke about the price being a real buffer in South Africa for certain stocks. The valuation doesn't give you that buffer for being wrong on the S&P. So in contrast to that, there are much more options, just like we spoke about in South Africa. You don't have to buy the S&P only. So this is the historic PE. It deviates from the forward PE, obviously. But the S&P PE is very high, call it over 20 times, versus the Chinese stock market at 12 times. So I hope from our presentation, you saw from Rashaad, we aren't calling a winner and a loser from the trade war. Everyone is a loser. Everyone will suffer. It's obviously a relative suffering, and some people will suffer a bit more than others. The difference for us is that we do think that good things are happening on a long-term basis in China, but you're also getting the opportunity to buy China at a 12 times PE, half the multiple to the US economy. So you've got that buffer in valuation if you're wrong. But what are we doing in forward portfolios? I think this is also, sometimes you talk generic indices, but I think you buy stocks, you buy companies within those indices. So what have we done here? We've taken our China holdings and we've shown on the bars the earnings growth that you'll expect to achieve from the companies that Foord own in China. And you can see that it's still over 10% earnings growth for the next few years. But you're getting the ability to buy them on the blue line at below 10 PEs once you remove the net cash. The Chinese companies are cash flush. And if you do remove that, it's still a very good opportunity within the context of the trade war if you are a long-term investor. So we've spoken about the South African equity opportunity. We've spoken about multi-assets on the inflation-linked bonds. We've now spoken about some of the global opportunities, making sure that you're more outside South Africa than outside America than buying the S&P. Another opportunity that's been a massive beneficiary for the overall portfolios is the gold price. In some of our multi-asset funds, we have over 5% in gold ETF, which is up 4 times since 2015. That's a quadrupling of the gold price in rands. In dollars, I think Rashaad did a presentation, I don't know if it was about a year and a half ago, where he said gold $3,000 is a prospect. It was an outlandish presentation that he did, but it's amazing how it's come to pass. So it's absolutely another important way. We showed you that the US 10-year, US 30-year didn't perform as the safe haven. The safe haven that's really come through and showed its stripes is gold. And it acts as a nice diversifier for the overall multi-asset portfolios. The one thing that we haven't covered is the rand. The rand is either, so let's explain the chart. On the rand, the line is the unit labor cost, which is a rough estimation of the cost of production of any widget in a country, of produce it in South Africa versus America. And obviously that will be upward and to the right on this chart. The rand will continue to weaken because our productivity is lower than the US and our inflation is generally higher. What we're saying here is if you focus on that line as the lower bound, it's the line, but we think that the rand, the green line, will continue to trade at around 1750, which is the line, all the way to the 20, which is the 2 standard deviation upper bound of that line, given the risks around tariffs, given the risks around the GNU, given the risks around the slow growth and the debt. We do think that those are the 2 numbers you should think about for the rough range that the rand will trend, obviously with a weakening cycle. Given all the opportunities that we see in China, outside South Africa, we don't think that the rand is a hindrance either way. We think the rand is roughly in the middle of that upper bound chart, and we'd say that it's roughly in the normal range of expectation.
Thanks, Nick. One of the questions that we get often, it's a difficult one to answer, I know, so it's a bit of an unfair one to ask you. But one of the questions we get asked regularly, so I think it's worth unpacking in terms of how you might answer it or what you might think about how to answer it, is what percentage would you recommend a retail investor based in South Africa hold offshore in terms of their investable assets? So how would you go about answering that question if you were asked that at a dinner party, for instance?
Yeah, 100 if you see a problem in South Africa, and 0 if you, or 100 if you're confident, and 0 if you're not. I mean, it's a bit facetious because it is always everyone wants a number, and you can put it into a Monte Carlo simulation. It will do a whole bunch of things and give you an optimal number. We don't believe in optimal numbers. So what I would point you to is the Foord flexible fund of fund as the best idea at this moment, given the constraints and opportunities of a portfolio that is unconstrained. What are we doing? And we're in the kind of 50, just over 50% offshore range for an overall portfolio. This is bearing in mind that this individual, and once again, it's impossible to set a portfolio because everyone has their own personal circumstance. But for a person that needs an unconstrained and is a RAND benchmark, meaning they live in South Africa, just over 50% would be roughly, given the opportunity set that we see offshore. But I don't get too fixated on that number. If there are better opportunities in the offshore market in South Africa, it could be 70. If there are better opportunities in South Africa, why can't it be 70 here? Because it's got to be dependent on the opportunities at that moment.
I guess one of the benefits of the offshore allocation increasing over time in the Regulation 28 funds is we can take up to 45% offshore,
flexibility,
which is not far off of that number. So we do have a lot more flexibility to find opportunities now, don't we?
The more flexible you are, the more we can do for you.
Okay, unfortunately, we are starting to run out of time. So I'm going to wrap up here, but I'm going to first give you a summary of some of our thoughts today, just so that I leave you with a clear idea of our views. So we spoke about how the world has become very, very integrated over the past 50 years. And while the US is leading the push to retrace some of that globalization, US wealth is also very much linked to global prosperity, as are living standards in the US as well. So they're not as insular as an economy as one would, or the media and many coming out of the US would have us believe. Many companies, in fact, are actually dependent on the rest of the world for their revenue. So in particular, the Magnificent Seven, who obviously make up a substantial portion still of the US stock market, and in knock-on effect of that is they make up quite a substantial portion of the global stock market, all have more than 50% of their revenues actually coming from outside of the US. And the US is actually not playing with a very strong hand at the moment. It's got very high levels of fiscal spending, it's got a widening budget deficit, and that's after a time of relative economic prosperity. So usually you see those kind of deficits during tough economic times. It does mean that there's one less lever to be able to prop up the economy if it does come into more difficulty. Also, the whole concept of US exceptionalism is actually being challenged right now. If we see the movements in the US 30-year yield, US bonds being sold off, and of course the weakening of the dollar, that is starting to raise some questions about how sort of watertight that argument is that there is no alternative to the US. But regardless of all of these question marks, the valuations for the US markets are still actually quite high. So there haven't really been any downwards earnings revisions. And of course, it's still trading at a pretty high multiple relative to its long-term history. So at Foord, we believe that there are better risk-return propositions elsewhere in terms of stacking the odds in your favor of better returns going forward. On the local side, things are looking a little bit precarious for the GNU, remembering that the GNU was one of the key reasons why the market did re-rate substantially, because it was seen to be a really important part of generating or moving towards the structural reform which will actually create economic growth here in South Africa. So with everything going on, there are a few question marks about that. So we think that, unfortunately, we're going to have more of the same, not necessarily a deterioration, but we're going to have a muddle-through environment with constrained economic growth here in South Africa. We are obviously, as Rashaad explained, quite dependent on what happens on the global side as well. So it will be very much a case of investing very specifically in businesses which have been able to dodge curveballs, which have the balance sheets which stacks the odds in their favor, and quality management teams which actually are able to still grow their earnings outside of quite a difficult economic climate. So regardless of this, we still fortunately see quite a wide opportunity set in South Africa. We've got many multinationals listed here, and we've got some phenomenal local companies who've really been able to buck the trend and deliver excellent returns on capital for their shareholders against a difficult backdrop. So those are the types of companies that we'll continue to focus on. Inflation-linked bonds do provide a really good opportunity to lock in some really attractive real yields or returns over and above inflation, which of course is the ultimate way to grow capital over time, is to actually actually deliver meaningful inflation-beating returns across any of the investments that you make. So we think that that's a very attractive proposition right now. And we actually have started to increase our exposure to some of the longer-dated nominal government bonds here in South Africa, because the yields have actually risen quite dramatically and now actually present quite a good entry point. Lastly, gold is a really good shock absorber in portfolios. We have gold in our portfolios not because we think it's going to do the same returns, the phenomenal returns it's seen over the last few years, but really as insurance against other things going wrong. So it's a very effective diversifier in portfolios. So I hope that gives you an idea of how we are navigating the current very choppy, very wobbly backdrop. Thank you, Nick and Rashaad, for your contribution, for sharing your insights today. Thank you to everyone who's joined us. I just want to remind you that there will be a survey that pops up when you end the session or when we end the webinar. Please do give us your views. We'd like to hear more of what you want to hear about. If there are questions that have come through, I saw that there were some questions. I will reply to them personally, so you will get an answer to some of those questions. Thanks, Nick and Rashaad, for joining us. And thank you to everyone who's joining us online. For those of you who are driving over the long weekend, please drive safely. See you next time. Thanks again.